Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights. So, this lecture is all about stocks and stock valuation. And we're going to start with the valuation piece, and then we're going to look at some of the additional features of equity securities, and that will wrap up the chapter. So, without any further ado, let me put my slides up here, and I will get out of the way. And we will begin Chapter 8. So, like I said, we'll be starting off with some stock valuation. We'll look at some of the features of common as well as preferred stocks, and then some of the features of the stock market itself and where those securities are traded. So, valuing a bond is relatively simple because we have known future cash flows. There is certainly a default risk, but that can be taken care of by altering the yield, the required rate of return, that is, that we demand for that particular bond. Based upon a higher default rate means we demand a higher yield, and so forth. And a stock, the problem is that we don't have any clue what those future cash flows are going to be, and they may go on forever. There is no maturity date on stock, so theoretically, the time that a stock has to go is infinite. And then finally, what's the required rate of return on this thing? How do we figure out what it should return to us? And so we'll talk about all of those things. Dividends actually are one way for a stock to reveal what its future cash flows may be. Dividends have been used quite extensively in the past. There's less use of dividend payments on today's stock market in the typical equity issuance than there used to be, largely because companies have decided, instead of giving back money to shareholders through dividends, that they'll give them back money through stock repurchases. We're not going to get into that in this chapter, but nevertheless, that has been more widely adopted, especially among growth stocks, and you see that much more frequently on all stocks in general. Fewer stocks that pay dividends. Part of the reason too is that in a normal taxable account, dividends are taxed at the current rate. Now, there are some details that allow a dividend to be qualified, in which case the taxes that they face are different, but nevertheless, dividends are a problem because of the double taxation. They're taxed at the corporate level and they're taxed at the individual level. So buybacks have been more favored by companies recently. All right. So let's get started by looking at, here we have a stock that we somehow or another know will be worth $70 in 1 year from now, and that it's going to pay us $10 in a dividend. And we also happen to know that we need it to return a 25% rate of return. Now, we want to try to calculate what price would be a fair price to pay for such a stock. And if that's the case, we simply take the sum of the payments here, the dividend plus the price that we'd be able to sell it at in the future, and we discount it back one period at 25%. So a $64 price on a stock that will pay a $10 dividend and then be valued at $70 at the end of that period would be a reasonable stock price to pay. We can also generalize this down here in this formula, that the price today, notice the subscript 0, that's indicative of today. We're assuming we're standing at time 0, and that price is a function of the dividend that gets paid at time 1 year from now or one period from now, plus the price that we can sell it at time 1. So we're going to receive the dividend, and then immediately after that we would sell it. And then here is R, which is our discount rate, our required rate of return. In this case, in this example, that was 25%. So fairly simple, but the big problem is that we don't know what the dividend's going to be, and we don't know what the price of the stock is going to be in the future, and we don't really know in the real world what the required rate of return is. So these things are problematic. Now, a stock that does pay a dividend, the pattern that that dividend takes is very constant. It's a rather slow increase, and what we see is a very constant level, and it slowly goes up year by year. Typical company that does pay a dividend will only pay out a very small fraction of their current earnings. So their net income is their current earnings, and oftentimes they'll pay out maybe a tenth of that. And the rationale is that they never want to have to stop paying that dividend, because if they do, investors assume that that's an extraordinarily bad signal about the future viability of the company. If they can't even pay out this small pittance to shareholders, then the company must be in really deep trouble. So that's also why companies pay out such a small fraction of their earnings, is that they want to be absolutely 100% sure that they can continue that out to pretty much forever. So that dividend, let's assume that we can know more or less what that dividend is going to be. There are ways to figure out what the required rate of return is, or at least to come up with some guesstimate of that. A logical model called the capital asset pricing model. That's just one of many possible models. That's a very old model, and it's a very simplistic model, but it does give us an estimate of the required rate of return. And this is where, if you've heard about beta, the beta is what comes out of the capital asset pricing model, and that's what we use to calculate the required rate of return for a particular stock. But I'm jumping ahead a little too fast. Let's get back to kind of the very basics here. So let's say that at period 1, we are looking for the price. Well, that price would then be a function of the dividend that gets paid at the end of the next period, 2, and the price that we can sell it for there. And we're going to discount both of those at 1 plus R, the required rate of return. And there's always an implicit 1 up here for that exponent. So we can kind of generalize this. If you'll notice that here what we have is that pretty much at any point that we want to sell it, we'd receive the dividends up to that point, and then that last one we sell immediately following the dividend. Notice that here the exponent is 2 in both cases. We could actually rewrite this as D2 plus P2 divided by 1 plus R raised to the second, right? That's the same thing. And this dividend gets paid, and then just an instant later we sell the stock. So these actually occur at the exact same time. Now, if we want to keep extrapolating that out into the future and pushing off our time when we actually sell the stock, we can see that really it ultimately boils down to a stream of dividends, as is illustrated down here in this equation. And again, so this, these were we stopped here and we sold it, but the reason that it's worth P2 at that point is because of all of these future dividends, right? So if we keep substituting in, you can see that this becomes an infinite stream of dividends. Now, the growth stocks oftentimes will not, they'll keep some of the cash or not even pay cash at all in the form of a dividend. They may do stock dividends, but those are just simply a paper transaction. It really has nothing to do with any cash coming out of the company. Totally different topic. But nevertheless, suppose that these growth companies need all the cash they can get to grow the company up to a viable or a more sustainable level. Well, they're not paying any dividends. So are they worth something is the question. That's ultimately what this slide is getting at. Is it worth something if they don't currently pay a dividend? And the answer is, well, according to the authors say, well, it'd be worth absolutely nothing. Well, I'm not entirely in agreement with that. As long as the company is making money and is profitable, at some point in the future, they would have a liquidating event. And we could easily find somebody to buy a share as long as they can see an audited financial statement showing that the company is healthy and it's generating a bunch of cash flow and it's reinvesting those cash flows in itself. That's okay. That's really okay. Even if it never pays out a dividend, as long as it continues indefinitely and it continues to be profitable, then that company does have value. And I'm going to interject at this point. That's also why crypto is not an investment. Crypto is just a gambling casino because crypto doesn't generate anything. And it doesn't pay you anything either. So it's the worst of both worlds, right? You look at it, you can't tell what's it doing. It doesn't make anything. It doesn't produce anything. It can't possibly make a profit. There is no financial statement. So that value is truly zero. It's only worth as much as you can find somebody else to pay you for it. And hopefully they're a bigger fool than you were when you bought it at a lower price, presumably. But, you never know. Is it going to stay up at 70-some thousand where it is today, or is it going to fall back down to, I think it was at a low of about 16,000 less than a year ago. So very volatile, very, just not an investment. Stay away from it. But back to our real investment, stocks. So, the authors say, well, as long as there's some time when they pay out a dividend, and that's the part that I disagree with a little bit, that actually there's no reason that they have to pay a dividend at all. Now, they might actually do some stock buybacks, which is similar to giving money back to shareholders. And even if they didn't do buybacks, as long as they were able to profitably reinvest that money and the value of the company continued to grow and it continued to be profitable, in other words, its expenses were less than its revenues after taxes, then the company still has value. All right, so let's look at a company that has zero growth. Well, if it has zero growth, then we would have a dividend that is constant. D1 equals D2 equals D3 equals D4, etc., all the way out to infinity. Well, so here is the equation that we could use, and that's one possible way to do it. But actually, this looks like something else that we already know about, and that something else is called a perpetuity, right? It's a payment which is the same payment every period, and it goes on forever. And how did we value that perpetuity? Right down here. We took the cash flow itself and we divided it by the required rate of return. And that was the value of that perpetuity. So we can do the same thing here. The dividend is effectively a perpetuity. Now, if there is constant growth, then we have to deal with a dividend that is getting bigger, but yes, you guessed it. That would be just like the growing perpetuity. So D1 is equal to D2 grown at G for one period. And D2 is equal to D1 grown at G for one period. It's also equal to D0 grown at G for two periods. Notice the exponent up here. So you get the idea. We've got a constant growth rate here of G. When we try to value the entire company using this, what we find is that for the value of a growing perpetuity, it is the cash flow divided by R minus G. And that gives us the value of a growing perpetuity. This is known as the dividend discount model constant perpetual growth version. It's also known as the Gordon growth model. Goes by both names, are interchangeable there. In this example, suppose that we have a dividend that just got paid of $2.30. That D0 just happened an instant ago. The required rate of return we've calculated using CAPM, and we get that it's 13%, and we've estimated that this dividend is going to grow at 5% every year. So now we have some numbers to plug in here, so we can plug in D0 is 230, 1 plus G would be 1.05, and then 0.13 minus 0.05 is the denominator. And when we do the math, we come up with a value of $30.19. Now, I wanted to show you just a kind of a analytical proof that this formula is actually right. I've got a spreadsheet here. Oops. What I've done with this spreadsheet is I've taken the values out of that problem. So notice that we have R up here at 13%. We have a G of 5%. We start off on a dividend of $2.3. And then the next dividend is 2.3 times 1.05, which turns out to be 2.415. And then the next dividend is 2.415 times 1.05 again, and that turns out to be 253,575, and so on down the line. You get the idea here, right? So in column D here, this is the present value of this value. So all the way down here, you'll see that $3.08 that we have as dividend 6, the present value of that at 13% is $1.48. You can check that out with your calculator just to make sure that I've got the right numbers here. Now, I've done this all the way out, and I've taken it out 75 years. And notice what happens to the present value of a really big coupon, or sorry, a really big dividend. Got $89 of the dividend 75 years from now, but the present value of that $89, it's not even a penny. It's 0.9 cents. Now, over here in column F, what I've done is I have added up all of the dividends for various periods of time. So in this cell, I've got 20 periods. So I've added this value and all the way down until I get to here, and I stop. So I've added all of those up, and that totals up to 23.23. So $23, not very close to the price that we saw in the PowerPoints of the $30.19. But let's go more periods. Let's look at going out 50 periods. Well, when we go out 50 periods, we're adding up all the way out to right here. We're going to stop there. When you add all those present values up, we get $29.42. Now, that's getting reasonably close to our $30.19 that we got from our the formula for a growing perpetuity. Let's go all the way out to 75 years. And here we see we get $30.06. That's just a little bit off the $30.19, just pennies off. So you get the idea. You notice that as the horizon goes out further, we're approaching $30.19. Now, if I took this out to, 100 years, that would probably get to like $30.18. And anything beyond that, I've continued to approach, but slowly, tenths and hundredths of a penny for decades on top of the 100 years. But you get the idea. This is somewhat of you can think of this as an analytical proof that indeed that formula for the growing perpetuity is actually correct. In fact, if you want to try this for yourselves, just make up the same set of values and take it out to 100, and then take it out to 200 years and see what sort of numbers you get. Take it out to 300 years, see what you get. You might be surprised, but it will never go above $30.19 if you do the formulas correctly. All right, so let's get back into this. And all right, I'm going to move on from, I'm not going to, they talk about how can you figure out the price at time 5, and if you take the dividend at time 5 and you grow it, there's what the dividend would be. It's 230 times 1.5 raised to that. In fact, this is an error. This should be 1.05 raised to the 5th power, and that turns out to be 1.2763. So the dividend at time 5 is $2.935. So we grow that $2.935 for one more period. So now this value is actually D6 right here. And then we discount it we divide it by R minus G, which turns out to be 8% or 0.08. And we find that the price at time 5 would be $38.53. But again, we could keep doing this exercise over and over and over again, and we would still get that the value today is $30.19. The value in the future is going to be higher, but obviously the present value of that is still going to be considerably smaller. And when we add that plus the dividends that we would receive in the interim, we end up with the $30.19. How about uneven cash flows? What if we have non-constant growth? Well, one method, there's a two-stage method that we could use, and we're going to build ourselves into that. For the moment, we could think of this in two separate calculations. We could value, in this case, we've got a dividend in one period, we've got another dividend in 2 periods, and then we have a dividend here in period 3 that then at that point is going to grow at a constant rate. So the first 3 years, this first 3-year period, we've got non-constant growth. And then from there on out, over here, we've got constant growth at 5%. So there are multiple ways we could handle this. But the way that your authors show this is, well, let's try to calculate a price at time 3. And so that price at time 3 is going to be right here. Imagine us standing here. We've just received the $2.50 dividend, and now we're looking for what's it worth as an ongoing firm. Well, it's worth whatever the present value of all of these future dividends growing at 5% are. So we can use our perpetuity, our growing perpetuity formula, and we'll have D3, which is the dividend we just received. We're going to grow that at our 5% rate for one period. That'll be D4 now. And then we're going to divide that by in this case, R is 10% and G is 5%. So when we do the math, it gives us a price of $52.50. Now, add to that the dividends that we'll get in the non-constant growth period, and that would be D1, D2, and D3. And we're discounting those as well at R for 1 period, 2 periods, and 3 periods. And again, this D3 and this P3 actually occur at the exact same moment. D3 is just an instant before P3. But for all intents and purposes, we could add them together. So we could have the $55 divided by 1.1 raised to the third power. And that would give you the same value as these two fractions here. And then get the present value of these two, add them all together, and we find that this particular stock is worth $43.88 today. So now we have a method of dealing with no growth, constant growth, and even non-constant growth. We can actually generalize this non-constant growth into actually two different stages of growth. So maybe we've got a first period that has either a very high rate or a very low rate of growth. And then we have a second period that has a more conservative growth rate over a long, from there out to infinity. So we label the first period as G sub 1 for T years. And after that, we have the growth rate becomes G sub 2. And like I said, typically the G1 is either really low or really high because we've got a company that is really distressed maybe in the short term, but will revert back up to a steady state at some point in the future. Or we've got a very high growth firm like a startup or a tech company that has got a product that is being sought after by the marketplace. So they can have a really high growth rate early on, but then they level out. And this is very common situation. So this formula is very useful. Now, to do this, we've got to deal with this in two pieces. We're going to deal with first the first stage of growth, and then this is that second stage of growth. Okay, so the first stage of growth, and I'm just going to give you an intuitive sense of what's going on here. You can think of it this way. Let's start a timeline. Let's go out to T, and then we'll go out to infinity. All right, so this formula right here, that's the next dividend, and we're dividing it by R minus G. So actually, that's the value for a growing perpetuity. In other words, that's the value of this first growth rate from here all the way out to infinity. That's this guy right here. All right, and then inside these brackets, we've got two terms, 1, and then we've got this fraction raised to the tth power. So let's deal with the 1. If we take, let me clear off my my markings here. And let's change the color of this. Let me go over here and we'll do this. And this is T. All right, so this is that entire time period out to infinity. So this times 1 is still this, right? Makes sense. Now, this 1 plus G1 over 1 plus R raised to the tth power, that is a little different, right? And intuitively, what I want you to think of, let's worry less about where that fraction came from and how we arrived at it, but let's assume that what that actually does when I multiply that by this value of a growing perpetuity, what it does is it subtracts off this amount. It subtracts off from point T all the way out to infinity. So in other words, what I'm left with is this value right here. So what I'm getting in this formula is this whole piece of it is giving me the value over this time period from time 0 out to time t. And I'm doing that by calculating the value from time 0 all the way out to infinity. And then I'm subtracting from that the value from time t out to infinity. And I'm left with this period right here. All right. Now, this, I'm saying, is the price. And again, I've got to clean up my mess here. And all right. So this is the price right here at time t. So in other words, it's what the stock is worth at time t, and that's all of this time period here, from time t out to infinity. That is what that price represents, and I'm going to discount that price back to today at my required rate of return for t periods. So I've got the value over this time period already. I'm going to get the p sub t, and which will give me the value out in this time period. And then I'm going to discount this back to today. And I'm going to add the two pieces together. And I'm going to have my value at time 0. Now, by the way, down here, what is that p sub t? Well, again, it's nothing more than the future dividends. So it would be dividend t plus 1. So this next period out here is t plus 1. And the next one is t plus 2, and so on. Well, so I'm looking for the dividend at t plus 1. That's the next one. And that would be the beginning dividend, d0, times 1 plus the growth rate for the first period for t periods, times 1 plus the growth rate for the second period for just one period. There's an implicit 1 up here. And then I'm going to use that same growing perpetuity formula, that closed form solution for a growing perpetuity, and that will give me my p sub t. If I want to run this with an example, let's say that we've got a dividend that's expected to grow at 20% for the next 5 years, and then at 4% from there on out. And this is a very common example where we've got a firm with supernormal growth in the short run, but that can't be sustained forever. It's going to have to level out, or the company becomes bigger than the whole economy, right? The economy only grows at 3% typically. GDP, real GDP growth is around 3%. If the required rate of return is 10%, what's the value of the stock? And we're also told that the dividend was just paid. That would be the d sub 0 is equal to $2. All right, so how do we do this? Well, first off, let's get the price at time 5. And that would be dividend 6. And it's a growing perpetuity, so we just take dividend 6 and divide it by R minus G2. How do we get dividend 6? Well, we grow the initial dividend, our $2, at the first growth rate, because we got to get through that 5-year window. We've got to get through there. So think of it as, this is the supernormal growth. And then from here on out is the normal growth. So this would be the 20% period, and this would be the 4%, right? So we've got 5 years in here where it's growing at 20%, and then we're looking for D6, which is right out here. So here is 1.2 raised to the 5th, and 1.04 raised to the first. And when we do that calculation, we find that our dividend at D6 is actually $5.18. And then we divide it by 0.06, and we get that P5 is $86.26. And that would be P5. Now we still need to deal with the first 5 years of value, the first 5 dividends. And we can do that by using the rest of this formula. So we're going to use, we've already calculated this. Now we need to calculate the first 5 years value, and then we need to discount P sub t back 5 years as well, and then add the two together. So the first 5 years, we can use this formula, 2 times 1 plus the growth rate of 20%. We're going to divide that by 0.1 is the R, and 0.2 is the G. Notice here that this is going to make this fraction negative, right? 0.1 minus 0.2, that's a negative. And that's going to turn that whole fraction into a negative. And no matter what we do, we multiply that by 1, it's a negative. Well, that's okay in a two-stage model. The G1 can be larger than R in a two-stage model. Now, G cannot be larger than R in a one-stage model because that would make price negative. But when we have 2 stages, we can have that first growth rate larger than the R. And we will still get a positive price out of it. We'll still get an accurate price given the cash flows that we've are using here. So when we plug and chug, between that first 5 years, which is represented here, plus the present value of that $86.26, we come up with a stock price of $66.64. That is a two-stage dividend discount model, DDM. All right, and again, very useful model to have and to know how to use. Now, how do we get this required rate of return? Well, the authors suggest one method is to kind of reverse engineer ourselves into that. So what they've done is they've said, well, let's take that formula that we've been using for a growing perpetuity and solve for R. Move things around and solve for R. And when we do that, we get something that looks like this. We get D1 over P0 plus G. Now, D1 over P0 is a very well-known ratio metric, and that's the dividend yield. That is, what percent of price do we get back in the next year's dividend? And then G, of course, is just our expected dividend growth rate. So if we wanted to put some numbers on this, if we look at, in this particular example, if we look at a $1 dividend on a $20 stock, and we have a growth rate of 10%, then that would be 0.05 plus 0.1, or 15% required rate of return. So it's basically, another way to view it is it's the dividend yield plus the capital gains yield. The growth can be interpreted as the capital gains yield. That's how we get R. Now, I know you're probably saying to yourselves, well, wait a minute. How do we know what the growth rate is? It's a good question, and one not easily answered. Another way to get R is to use the CAPM, the capital asset pricing model. All right, so what we've just been looking at is what's known as a fundamental valuation. The dividend discount model is one of multiple fundamental valuation techniques. Some of the others that you might have heard of or might use would be the residual income model, the free cash flow model, and then the kind of the big kahuna of them all would be what's known as the DCF, discounted cash flow analysis. For that, we would project out future financial statements, known as pro forma financials. We might project those out for 5 years. We might come up with a terminal value after year 5 and discount all of those cash flows back to today and calculate a value on that basis. This next section, though, actually uses a very different type of model. This type of model is called a relative valuation. And a relative valuation is very much like what we use in the residential housing market. So I don't know if you've owned a house and sold it. Maybe your parents have. How do you value a house? Well, if you've gone through that process, you probably already know that what you do is you go around the neighborhood and you look for houses sort of like yours that have just recently sold. And you look at the number of square feet in that house that just sold, and you divide the price by the square feet, and you get a price per square foot. Then you take the number of square feet in your house that you want to sell, and you multiply it by that dollar per square foot. Now, your comps, your comparables, your previously sold houses, hopefully that's within the last month or two. You don't want any comparables that sold maybe 2 years ago or 3 years ago. The market could have been very different at that point. And so you want something relatively recent, and you want several of them because, well, an average can be better, especially since we don't know whether the comp is really close to our subject house or not. So we take 3 or 4 comps. We get an average price per square foot, and then we multiply the number of square feet in our subject house by that price, and we come up with a value for our subject house. Well, we're going to do exactly the same thing, but instead of using a price per square foot, we're going to use one of the ratios, in this case, PE, price over earnings. So PE is simply price divided by earnings per share. Price would be the price of a share of stock. EPS would be the earnings per share. This is a very widely used measure. And this is also a measure that can be used to help you decide whether a stock is a growth stock or whether it's a value stock. Now, a growth stock typically will have a high PE ratio. A value stock will typically have a low PE ratio. The way one thinks about these PE ratios, I'm going to skip ahead to this slide for a moment. They give you PE ratios based upon different industries. So if we look in this column, for the apparel industry, the average PE price over EPS is equal to 10.5. Well, really, this is not just 10.5. There's always an implicit 1 in the denominator here. We just don't write it. But I think it helps to actually write that out, because the way I interpret this is to say that a dollar's worth of earnings next year is worth $10.50 to us right now. And you might go, wait a minute, that's not how that works. And you're absolutely right. But that's what this ratio actually represents. It's saying that we're paying $10.50 for a dollar's worth of earnings next year. Well, there's not just next year, right? There's also the year after that, and the year after that, and the year after that, and the year after that. But wait a minute, it's not just that dollar, because I could have the company for 10 and a half years and I get back my $10.50 that I just paid for that. But actually, I'm taking the present value of those future cash flows. So it's not really a dollar that I'm getting. I'm getting like 90 cents for the next one, and I'm getting 80 cents for the one after that, and 65 cents for the one after that, and so on down the line. So actually, I've got to go much further out than 10 years. Unless the dividend is growing. In which case, then, if it's growing at a moderate pace, Next year's dividend might be $1, but the dividend after that might be $1.15. It might be $1.20 the year after that. It might be $1.30 the year after that, and so on. So I'm growing the dividend, even though I'm discounting it back. Maybe I'll get up to my $10.50 before I even get to year 10. Now, if I have a PE ratio, for instance, like, let's see, the beverage industry. This seems like a very high PE for beverage industry. I'm not sure where they got this data from, but let's take them at their word. There we're paying $40.90 for $1 worth of earnings next year. Now that's going to take a long time to get back, unless the growth rate is really big. Got a really big G. This one has a really small G. Then that dollar might grow to 2, and might grow to 4, might grow to 8. If it's growing at that sort of pace, then it won't take long to get my $40.90 worth of value, even in present value terms. So you get the idea here. This PE ratio is telling us what $1 worth of earnings next year is being sold for today. But it's not really next year. It's not just next year. It's next year and the year after and the year after and the year after and the year after. Hopefully that gives you a little better sense of what this PE is doing. Now, how do I actually do this valuation? Well, the valuation itself is quite elementary once we understand what's going on. All we do is we take our benchmark PE ratio, that shouldn't be there, that N, and we multiply it by the EPS of the company, the next year's EPS. Simple, right? And again, since we've got price over EPS times EPS over 1, EPS cancels, and we're left with price. Now, where does this benchmark PE ratio come from? Well, it comes from comps, just like with the house. It comes from other companies that are very much like our subject company, and we look at what their PE ratio is. And we do that for 3 or 4 or 5 or 6 or 7 other companies. We get an average PE. We say, well, let's use this average PE from these other 6 or 7 companies and see what price we get for our subject company by multiplying that average PE by the subject company's EPS. If the price that we get out of this formula is above what the market price is, then we have a company that we probably want to buy because we're expecting the price to go up in the future. If the price that we get out of this formula is below the market price that we observe in the stock market, then we might want to sell if we own it, and we might even want to short sell if we don't own it. That's about it for PE ratio. There are a variety of other ratios that get used. Price to sales can be used. Price to cash flow can be used. Even something like down here, they mention EV to EBITDA is a very popular ratio. EV is enterprise value. Enterprise value. And basically all that means is it's the value of the firm minus any excess cash that's on the balance sheet. And EBITDA is actually earnings before interest, taxes, depreciation, and amortization. So we're moving up the income statement quite a bit. And we can actually get a value for the entire firm, including the debt side of it. And to actually get the equity value, then we'd have to subtract off the debt from that, and then what we're left over with is the equity value. But PE is by far and away the most commonly used ratio here. Price to sales is not very good. In fact, I would recommend you try to avoid even thinking about it, because that's it's so far up toward the top of the income statement. The way I think about this is, we've got, let's say we've got an income statement here. We've got revenue at the top. We've got cost of goods sold here. Subtract that out, and that gives us our gross profit. Then we've got selling and general administrative expenses, and we get down here to our operating profit, and so forth. Eventually, we get down to net income after we've paid everybody else, interest, taxes, depreciation, so forth. Well, this net income is 100% of that is equities. It belongs to equity. So that's why price over EPS is a consistent ratio. In other words, price of the equity over earnings per share that goes to equity. That's good. But if we actually did something like price over sales per share, we're way up here at the top of the income statement. And that means that, we got to pay costs for our cost of goods. We've got to pay selling and general administrative expenses. We've got to pay interest. We've got to pay taxes. We've got depreciation in here. All kinds of things coming out. So to get a good comp, we need a comp that has almost the exact same cost structure. That is a very rare animal. We're not going to have a comp that's like that. Maybe an example, this is not a great example, but say we've got a 3-bedroom, 2-bath, 2-car garage house, 2,000 square feet, and our comps are houses that are also 3-bedroom, 2-bath, 2,000 square feet, but they're built of sticks, 2x4s, whereas our subject house is built of stone or something like that. It's a very different construction technique, much more expensive construction, much more durable, much stronger, and will last much longer than the other houses. Well, would I want to use those houses as comps? No, probably not. They still provide shelter. They still give me the same 2,000 square feet, but the subject house will last a lot longer and have a lot lower maintenance than the comps. So I really can't use those to give me a good estimate, anyway, of the value of my subject property. It might give me a low end number, but it certainly won't give me the value of that house. I think that might work as an analogy. But the point is that the sales per share, those revenues don't all accrue to equity. They first accrue to paying off, inventory that we bought from vendors, and then we've got salaries, and we've got depreciation, and we've got interest that goes to debt holders. We've got taxes that go to the government, and so forth. So hopefully you get the picture. All right. Let's go on and just kind of summarize all of this. We've looked at 2 methods. We've used a fundamental valuation technique, the dividend discount model, and we've used a relative valuation technique using price to earnings, or the PE ratio as it's known. The first one here, we can value a stream of dividends, and whether they're constant, growing, or even non-constant. In the constant growth case, it's nothing more than a growing perpetuity. In the non-constant case, we can have a series of cash flows that are non-constant, and then the cash flows out beyond time t are constant, and we can value those using just our regular growing perpetuity or just an annuity formula depending upon what the growth rate is, whether it's positive or just zero, respectively. And that formula takes this form to calculate that P sub t. If g is 0, then it just reverts to a value of an annuity. Then we have the two-stage method, which allows us to value a company that has maybe a supernormal short-term growth rate followed by a lower long-term growth rate. And then we use the relative valuation method. Here we're taking simply the benchmark PE ratio times the earnings per share. And then to calculate a required rate of return, we can think of that as a dividend yield plus a capital gains yield. All right, so we've finished up talking about valuation. And mind you, that was only a very basic introduction to it. There are a variety of other techniques available, but that gives you at least a smattering of what can be done. Now we'll look at some of the equity security features, and we'll also talk a little bit about where these equity securities are traded and how those markets function, in particular the NYSE and the NASDAQ. All right, so when it comes to other rights that shareholders have, in addition to a equal share of the cash flows that the firm, the residual cash flows that the firm generates, voting rights are probably next in importance. Voting rights give the shareholders the right to have their say on some very important issues related to the operation of the firm. In particular, one of the things that they're regularly asked to vote for are positions for the board of directors. The board of directors represent the shareholders, obviously, and so they are elected by the shareholders. There's a difference in terms of the equity securities when it comes to voting rights, and the difference is between cumulative versus straight voting. Let me just put an example together to give you a basic idea of the difference between those two. Straight voting is when you say, let's say we have 4 open positions for a board of directors, and maybe there are 8 different individuals, 2 competing for each of the 4 seats. Well, you can vote in the straight voting. You have, let's say you have 100 shares, 1 round lot. And so that means you get to vote 100 of your shares for each of the positions. So 1 share, 1 vote. That would mean you have 100 votes for each position. But you can only apply the 100 votes to the individual position. If you had cumulative voting rights, then you could take the entire 400 shares or the 400 votes that you have and vote for a single individual for a single position. This gives minority ownership a little bit more voice in the corporation. This would give a minority shareholder an opportunity to elect somebody to the board of directors when they might not otherwise be able to do so with straight voting rights. There are also features of the board that are fairly important too. Some boards are elected all at once. So let's say you have 12 directors, and at the end of the term, whatever that may be, it might be 2 or 3 years, all 12 go up for election. Other companies use a staggered board. In other words, only a fraction of those board of directors are elected each time they elect. And so it might be that 4 directors are elected out of the 12 every year. So this type of arrangement is viewed as an anti-takeover measure. In other words, if I was an outsider and I tried to get a position on the board and tried to get a majority on the board so I could actually take over the company, I wouldn't be able to do that immediately. I would have to do that in stages. And that would give the existing board and management team an opportunity to defeat my attempts to take over the firm. Usually staggered boards are viewed as not good governance. It is better to elect the entire board at once and usually the outside uh, parties that are interested in trying to get some board representation probably have a pretty good idea for what needs to happen to the company. This usually happens to companies that have become stagnant or some sort of entrenched management team that is not managing the company in as effective a fashion as it could be. Proxy voting is another feature that many firms have built into their shareholder rights. Proxy voting allows a shareholder to give their voting rights to another shareholder. So there may be somebody who's an external shareholder, a non-insider, that would like to take over the firm or gain some representation on the board of directors, and they would seek proxies from other shareholders of like minds so that they could vote their shares and attempt to get their slate of board of directors in, or possibly, attempt to get the company to do a particular thing. Anyway, that's it's something that's related to takeover. If you have a lot of protections against takeovers, then the boards become entrenched, management teams become entrenched. So that's not a good thing if you don't have proxy voting. Proxy voting helps to allow for other parties to gain control of a corporation. There are also different classes of stock. Most stock is Class A, common stock, and that's it. But you do see a number of companies with Class B securities. One of the classes is typically restricted ownership to usually that of the founders or insiders. And the reason for this typically is that those alternative class stocks have greater voting rights than the common stock that's available to the general public. This is a situation where, for instance, in Facebook, Mark Zuckerberg owned the class of stocks that gave him, I believe it was 5 votes per share instead of 1 vote per share. And for instance, that meant that he could have a minority ownership in terms of number of shares, but he would still have majority control over anything that went to a vote of the shareholders. Again, Class B or a second class of stocks that has enhanced voting rights, shall we say, is usually viewed as detrimental to the overall operation of the corporation, because again, it gives a small cadre the rights to outvote the majority of the shareholders. Some other rights that shareholders always have, of course, they have the right to proportional payment of the dividends. And in the case of a liquidation, they would also have the right to proportional share of the assets or whatever is left. Usually that's not a big deal because there's usually nothing left. And then they have the right to vote on other issues that are brought before the company. Usually we're talking about electing board of directors and the auditor for the firm, but there can be other issues that are brought to the shareholders, either by the company itself or sometimes by a small group of shareholders. Preemptive rights are very important. This is needed if new shares are sold. So when a company does its IPO, it might go IPO with, say, 10 million shares, and then a few years later it needs to raise additional capital, and it decides that it would like to raise that capital as equity. Then they do what's known as a seasoned equity offering. And that seasoned equity offering might add, so let's say it adds another 2 million shares to the total shares outstanding. Well, that means if I owned 100 shares out of the original 10 million and I did not participate in the seasoned equity offering, then my voting rights would be diminished, would be diluted. And this preemptive right gives me the right to buy the proportional number of new shares that I currently held in the corporation prior to that new share issue. So in my example, if I owned 100 shares out of the 10 million, and then there were 2 million additional shares being issued, if my shares had preemptive rights, it would mean that I would have the first right of refusal to buy an additional 20 million shares of that new offer, and then I would maintain my proportional voting rights. All right, so on to dividends. Dividends are, I think everybody knows what they are. There are a few things here that they mentioned that you may not be aware of, and that is that dividends are voted for by the board of directors. This is not a management decision. This is a board of directors decision. Another thing to be aware of is that from a legal perspective, corporations are not required to pay dividends, and they can forego a dividend. They can cut a dividend. So it's all up to the board of directors as to what they do. And the payment of the dividends by a corporation are not considered business expenses. Let me get out of the way here. Hang on just a second. They're not considered a business expense, and as a result, they are not deductible for corporate tax purposes, and you get taxed on them too. So there's a double taxation on dividends. The dividends that are paid for preferred stock are a little different. So preferred stock is usually thought of as some sort of a hybrid security. It's part common stock, part bond. And the part that is like common stock is that they do get what's referred to as a dividend, although it's a lot like a bond because that dividend is typically stated in the agreement with the preferred shareholders. And so, for example, in this particular case here, we have $100 preferred shares, or that's their par value is 100, and they pay a $5 dividend, which would be equivalent to 5%, a 5% coupon. Now, where they differ from bonds is that that dividend or that coupon is not required to be paid. A firm can forego paying the preferred shareholders their dividend. There is another issue down here when we talk about cumulative versus non-cumulative, and that affects the non-payment situation. So if the dividends are not paid to preferred holders for multiple periods, yet the preferred stock is cumulative, if the company decides to start paying dividends, they will have to pay all of the back dividends first to the preferred shareholders. Now, you might ask, well, why would they bother ever starting up again? And the answer is that actually, if they haven't paid the preferred shareholders their dividend, then they cannot. They're disallowed from paying common stockholders their dividend. So even if a company were to cut its dividend payments for a temporary period of time on both common and preferred, if the preferred were cumulative and they wanted to start up dividend payments to the common shareholders again at some point in the future, they would have to catch up all of the missed dividend payments for the preferred shareholders before they could then begin paying dividends to the common stockholders. All right, now let's start talking about market characteristics. Two terms that you really need to understand before we get into the details of this are what is a dealer and what is a broker. They both assist shareholders and investors in buying and selling securities. They stand ready to be the intermediary, if you will. The key difference between whether you're a dealer or a broker, though, has to do with whether you hold an inventory of the shares that you are buying and selling. If you do hold an inventory and you sell out of that inventory, then you are a dealer. And you're also quoting a bid price and an ask price. Now, the bid price is the price at which the dealer will buy at, and the ask price is the price at which the dealer will sell at. So when you think about buying, you're going to be buying at the ask and you're going to be selling to the dealer at the bid price. Now, the bid is always lower than the ask. So the dealer makes money when they buy and then turn around and sell at a higher price. That's their revenue stream. That's how they support their business. You and I, as investors, are actually on the wrong side of that. We lose every time we make a round trip. If we were to buy at the ask, the high price, and then immediately turn around and sell at the bid, the low price, we would lose money. But that's all right because we need dealers to intermediate in the marketplace. We need somebody there when we want to sell and there's no other buyer around. They will be the buyer. And vice versa. If we want to buy and there are no sellers around, they will be the seller. Now, a broker is different in that they don't hold an inventory in the securities. They simply match up investors with each other. They help to arrange that transaction. You can think of real estate brokers are the same sort of way. They don't actually own your house. They simply help you sell your house. Or if you're a buyer, you might hire a real estate broker to help you find the right house to buy. And securities brokers are just like that. Now, on the NYSE, the AKA Big Board, prior to 2006, the Big Board was privately held. It's somewhat ironic, right? That here is the preeminent exchange of publicly traded companies, and the ownership of that exchange is a private firm with partners, basically. These partners were called, they thought of themselves as seat holders. They held a seat, and there were actually 1,366 members or seat holders on the exchange. And you could buy and sell a seat just like you could buy and sell a partnership in another business. And the prices of the seats varied over time. Just before the NYSE became a publicly traded corporation, seats were selling for somewhere in the neighborhood of $4 million. In 2006, the NYSE became a publicly traded or publicly held corporation. So the seats, the partners went away, they were bought out, and the corporation then became a stock company. There's still seats per se on the exchange, but you buy a license for 1 year of being able to access the floor of the exchange. And typically that's in the $50,000 range. I don't know the exact price this moment, but it's not inexpensive, but it's not, certainly you're not buying into a partnership either. You're just buying a 1 year license to be on the floor. A year after becoming public, NYSE merged with Euronext and became the first global exchange. And then very shortly after that, NYSE Euronext merged with the American Stock Exchange, which was the third major exchange in the United States. And then in 2013, Intercontinental Exchange purchased NYSE Euronext. And so now they are known as ICE. Another thing to know about the NYSE is that it used to be a totally face-to-face market when it was originally founded, and it has become more of a hybrid market, and I would argue that it's not even a hybrid market anymore. It's very much an electronic market. The face-to-face activity is a tiny, tiny fraction of what it used to be, and certainly a tiny fraction of the overall volume that's handled on the NYSE. Let's see, with electronic trading, buy and sell orders go into the computer system and are matched up against the other side with very little human input in that. Most trades are made that way. There are still some people who inhabit the NYSE floor, the actual physical exchange itself, and the roles that each of those individuals take on is important to understand. First off, there is the DMM, the Designated Market Maker. These folks used to be called specialists, and a specialist actually had a great deal of power over a particular security. They had the monopoly right to buy and sell and post bids and ask prices for that particular security. But they also had quite a few obligations to make sure that the market operated smoothly. They could not trade ahead of customers and so forth. The NYSE changed that role a number of years back, and now we have what are known as these designated market makers. They are like specialists in some regards, but they don't have as many privileges as the specialists did. They are not the monopolist market maker. We have supplemental liquidity providers who also compete. And those folks are, you can think of them as kind of a backup to the designated market maker. Then there are also floor brokers, and these individuals usually work for one of the investment firms that has a seat on the exchange, and these floor brokers will actually execute the trades when a physical face-to-face transaction is required. So when it comes to how the trading actually takes place on the face-to-face side of things, I think a picture is worth 1,000 words. So this is a photo that I took about 5 years ago, last time I was on the trip where we took our bowler students to the NYSE and some other locations around New York City. But we did get to go down to the floor. This was actually shot from the balcony and looking down on the floor. And what you see are these posts. They're actually 8-sided posts that are located around the floor, and the top part is covered with panels, with display panels, and then down on the floor itself is where the DMMs are. Now, I would guess that this gentleman right here is a DMM. He actually works for a particular company, and that company is actually GTS. We can see it on his jacket there. So these DMMs are provided to the exchange by a few companies. And this gentleman probably had 2 or 3, maybe 4, 5, 6 stocks that he was the DMM for. And so if you wanted to trade that stock, you would walk over to this gentleman's post and you would tell him what kind of trade you wanted to execute, and he would take care of it. He's also, in this picture, he's monitoring some of the electronic trading that's going on, and also monitoring his bid and ask prices. Now we come to the NASDAQ, which actually it used to be an acronym, NASDAQ, with periods in between there. And that stood for National Association of Security Dealers Automated Quotation System. So, oops, what am I doing? I'm putting a G up there. That's a Q. So now it has actually become a word. So you capitalize the first letter and the rest of them are lowercase. It started back in 1971. It was a computer network of security dealers, and it's remained a computer network. There is no physical location for the NASDAQ. It is all electronic communications between the market makers and the investors. They are the second largest market in the U.S. NASDAQ dealers act as though as market makers. In other words, they're sort of like the DMMs. Oops, what's happening to my pen? They're like the DMM in the NYSE. They post a bid price and they post an ask price that they're willing to buy and sell at respectively. and they also will, hold an inventory of that particular security. The key difference between NASDAQ and the NYSE, though, is that there are multiple market makers. All right, so there are many of them. For the biggest stocks, there might be a dozen or a couple of dozen market makers that are competing with each other. Whereas on the NYSE, there is the DMM, and then we've got these new supplemental liquidity providers. But the numbers here, these market makers, these dealers, are actually in direct competition with one another. Whereas with the SLPs, I suspect that they are not in a position to be as much of a competitive threat to the DMMs. They're just there to help provide additional liquidity when markets get overwhelmed with volume. There are a variety of different levels of quote data that you can receive. Level 1 is the most basic level, and it simply gives us prices over the interwebs. Level 2 actually allows the people with that access to see the quotes, not only the inside quotes, but they also, I believe, will get the quotes from other dealers as well, and they will identify the dealer, and that becomes useful, if you know a particular dealer accustomed to their pattern of quoting. But then level 3 is actually only available to NASDAQ dealers. So those of us that are just average investors, we can have access to level 1 for free, or level 2 if we pay a little bit on a monthly basis. That level 2 access just gives us a little additional information about what the dealers are doing, what the market makers are doing. There are actually 3 NASDAQ markets. There's what they call the Global Select Market, and that's for the larger firms, the Microsofts, the Intels, which, by the way, are still traded on NASDAQ. It used to be that if you were a startup, you would start on the NASDAQ, but as you grew to a larger firm, you might very well migrate over to the NYSE. It was viewed as a more prestigious trading venue. Now, many of these new tech firms have grown up as part of the NASDAQ, and they just stay there. So there doesn't seem to be any reason for them to leave NASDAQ. The second market is the NASDAQ Global Market, which is for companies that are somewhat smaller in size, and there are about 1,130 of these firms. And then finally, there's the NASDAQ Capital Market, which is for the smallest firms, and there are another 1,800 listed on that. One last thing here, stock market reporting. There's stock market data about individual firms and the aggregate activity all over the place. Much of it is for free. For instance, here in this example, you can see this is off of Yahoo Finance, I believe. And it gives you quite a bit of information about each security. And I would also suggest that if you are anywhere near campus, that if you haven't already, come down to the first floor of the Bowler College and visit our Bowler trading floor. We have 12 Bloomberg terminals on the Bowler trading floor, and that data is much more extensive than anything that you'll find on the internet. And you can find out just about anything you want to know about any company and about the economy and about many other things, because most business that is transacted around the world has an impact on the value of securities. And people who are trading securities will often have a Bloomberg terminal at their ready in order to make good decisions about buying and selling a particular stock. So come on down. You can open up a Bloomberg account for free, and there are some good training material on the Bloomberg terminal as well. The Bloomberg Market Concepts is great. They also have a training module on ESG, if you're interested in ESG. and there's a Bloomberg Fundamentals of Finance as well. So if you'd like to see finance from a different perspective than what I'm presenting here, you could pop down there and take the Bloomberg Fundamental course. But I encourage you to check it out if you can at all possibly get down there. If you need some help with it, feel free to send me an email and let me know. I could always meet you down there and give you a walkthrough on the terminal. That is it for the moment, and so I'm going to jump back in, and this is the end of Chapter 8. This is the point actually also where you should be emailing me to schedule your midterm exam, and let me know when you want to take that, and I'll get things set up for you. Thanks so much, and I'll see you next time. Thank you. Bye-bye.